Welcome to our deep dive into a complex financial landscape. Today, we'll unravel why a staggering $100 billion in currency intervention couldn't stem the tide of yen weakness, and how the Bank of Japan's yield policy is stirring up market turbulence. With Japanese corporate profits soaring by an impressive 70% and the Nikkei climbing 4.71%, economists and traders are engaged in a heated debate. Are the BOJ's sterilization efforts and bond buying truly neutralizing the official exchange rate defenses? Let's find out. For several months, Japanese authorities have been on a mission to cushion the swift depreciation of the yen, pouring in a monumental $100 billion in direct foreign exchange intervention. However, a perplexing paradox emerges. While the Ministry of Finance sells dollars to bolster the yen, the Bank of Japan continues its extensive bond buying spree. This relentless quantitative easing keeps long-term domestic yields unnaturally low. Traders are now questioning whether these disconnected policy moves are actually undermining the currency's defenses. As interest rate differentials widen, the effectiveness of these interventions seems to diminish, leading to ongoing volatility in the US dollar to Japanese yen and other cross-currency pairs. The data paints a striking picture of Japan's economic landscape. Companies listed in Japan have reported a remarkable 70% surge in net profits for the April to June quarter, thanks to favorable foreign exchange dynamics from the weak yen and increased capital investments in artificial intelligence. The Nikkei 225 reflects this optimism, closing at 66,970.22 with a robust 4.71% increase. Leading the charge are precision instruments and technology stocks, with Recruit holdings soaring by 22.79%. In contrast, CyberAgent faced a significant downturn, plummeting 16.68%. This surge in corporate profits underscores a critical dilemma. Even after deploying $100 billion in intervention, the yen continues to depreciate, fueling record earnings while escalating domestic import price pressures. Across social platforms and trading desks, skepticism about the effectiveness of intervention is growing. Global FX traders are keenly observing cross-currency thresholds, noting that the euro to Japanese yen is lingering around critical points near 183.72. with resistance at 185.00 and support at 182.00. Market conversations depict potential official interventions as unpredictable rather than a sustainable strategy. Traders assert that these short-term currency interventions may create temporary spikes, yet macro-leveraged funds quickly re-establish their short yen positions as long as yield differentials remain anchored by the BOJ's ongoing bond purchases. Global economists are now voicing serious concerns over the conflicting policies at play. In a recent interview with Channel 4, Robin Brooks highlighted that direct currency intervention becomes ineffective without a simultaneous shift in the BOJ's yield policy, as the ongoing bond purchases keep long-term yields artificially low. Richard Werner, another prominent economist, warned that the BOJ's over-sterilization efforts have only worsened yen weakness. The consensus among analysts is clear: as long as the central bank's balance sheet strategies neutralize liquidity signals, physical currency interventions cannot lead to sustainable yen appreciation. The dynamics within the Japanese equity markets reveal a significant sector divergence. The precision instruments and technology sectors are driving the Nikkei's impressive 4.71% gain, fueled by a surge in global AI demand and favorable export pricing. Noteworthy individual stock movements include Recruit holdings, which experienced a staggering increase of 22.79%. Conversely, CyberAgent faced unique challenges, with a notable drop of 16.68%. Investors are beginning to understand that while yen weakness can boost revenues for large exporters, profit performances can vary dramatically across different business models. As global fixed-income desks and macro hedge funds navigate the complex landscape of Japanese government bonds and foreign exchange, two potential scenarios emerge. Should Japan prioritize currency stability and accelerate interest rate hikes, we could see a rapid spike in long-end JGB yields, significantly affecting global bond markets. On the other hand, if the BOJ continues to protect the domestic bond market by limiting yield expansion, the interest rate differentials with global peers will persist, sustaining structural yen weakness and pushing US dollar to Japanese yen higher while leaving euro to Japanese yen volatile between key levels at 182 and 185. For global macro investors and equity traders, assessing core risk parameters amid the uncertainty from central bank policies is crucial. Firstly, relying on uncoordinated currency intervention as a trend reversal signal carries significant risk, as evidenced by the limited lasting impact of the $100 billion intervention. Secondly, it's essential to monitor fixed income signals closely, as market swap pricing suggests a strong possibility of a BOJ policy shift in September. Lastly, managing risk around critical cross-currency resistance levels, such as euro to Japanese yen at 185, is vital. Investors should pay attention to any adjustments in the central bank's bond buying strategy rather than focusing solely on spot currency interventions. As we look ahead, let's analyze 3 potential policy scenarios based on current trajectories and market pricing. In the base scenario, market expectations align with a BOJ move in September, leading to moderate rate adjustments that slightly narrow yield gaps while supporting corporate earnings. The bullish yen scenario would see the BOJ decisively shift its sterilization strategy, allowing long-end JGB yields to adjust naturally, making currency interventions effective and potentially driving the yen higher, with euro to Japanese yen falling below critical support at 182.00. Conversely, in the bearish yen scenario, the BOJ may prioritize shielding the bond market over managing currency stability, leading to further widening of yield differentials, neutralizing official interventions, sustaining yen weakness, and driving corporate profits higher while increasing volatility across global currency markets. To wrap up, here's a quick summary. First, the $100 billion in FX intervention has proven ineffective due to the persistent bond buying by the BOJ. Second, Japanese Q2 corporate profits surged by 70%, propelling the Nikkei up by 4.71%. Finally, all eyes are on the BOJ's anticipated policy decision in September. What are your thoughts on the BOJ's yield policy? We want to hear from you. Leave a comment below, like this video, and don't forget to subscribe for more in-depth analysis of Japan's macroeconomic landscape.